Oh, next slide.
Okay, so hello, my name is Anna, and I work on several different projects. I spent many years managing pension fund money, hedge fund money, and I worked for various large asset management houses. What I'm doing now is I'm launching an important financial literacy project here in the UK. And we are already actually having agreements to expand in Nigeria and other parts of the world. So what would I do with the billion? Let me think. I would definitely put a chunk in generative AI. We are utilizing generative AI.
That's so you're saying venture, or you're saying public markets AI? How do you? This is assets.
Yeah. Okay. So I prefer venture. I spent my whole life in public markets, and we always look with a bit of envy towards VC world because they get audited once a year. Their performance is more stable, and my performance was audited every hour of every day. So anyway, I would speak to companies that have a big potential and actually can implement new technology fast, rather than playing on usual suspects. Several companies in the US that are always the winners. So yeah, generative AI would definitely be one component. I would look at the European banking sector. I believe they are recovering quite well.
You should be on the sector panel then.
My mother is
asset classes.
Asset classes. Okay. So Asian equities are an asset class, and yes, I think there is a lot of potential. They were lagging behind the US and some of the European markets, and there are some good valuations there. Bonds, the world was looking towards inflation-linked bonds for quite a while, but now it looks like inflation is slowly but surely getting back to the target, and high interest rates are actually have managed after some 18 months to bring inflation under control, closer towards 2% of the target rates. Commodities, I would not invest in gold. I think it has already done quite well. But I spent years working on high-frequency trading and investment. So we're always looking for different arbitrage opportunities in the short horizon, and there are always opportunities.
Peter.
Sure. Per from Women Family Office. By way of background, I'm a finance guy. I used to work at Goldman's originally. I'm an author, published book. We do charity work. I'm an adventurer, do adventure stuff. Today's actually a very big day. The first private astronaut did an EVA, an extra vehicle activity. I stepped outside today, so it's a very big day in the world of space. So I literally just came off Turkish television before coming on here, talking about that. I'm going over in 2026. Apart from that, so I still have a merchant bank, have an accounting firm, have the family office. Coming to the asset allocation question, we are not so clever on the early stage stuff. So my asset allocation to VC would probably be 5% or something, quite small. Just have a few chips in there, but wouldn't say that's our core skill set. PE, probably 15% or thereabouts. Real estate is something we like a lot, and there's always opportunities in various geographies, whether it's UK, Europe, or North America, etc., or indeed the sub asset classes of real estate. We cover everything from senior living to care homes to hospitality, offices, resi, portable, you name it. So you'll always find pockets of opportunities. So I would probably put a 30% at least allocation to real estate. Public equity markets, obviously you've got to time it a little bit, which sometimes is difficult, but it would have been a shame to have missed out on the Magnificent Seven in recent times. I mean, they're 40% contribution to the S&P, and the S&P has done quite well. Thank you very much. The exception to that would obviously be 2022, where, as we all know, the Nasdaq was down about 30% and the S&P was down 20-odd%. for those years, like 2022 or 2018, we always have the CTAs in the portfolio as a hedge against that. So we would have an overlay of sorts in CTAs, and that will vary anywhere from 10% to 20%. And then the balance of the money, I'll stick that into private debt. We're not particularly keen on fixed income in general, but in certain pockets of private debt, in particular within real estate, you actually get almost equity-like IRRs today, almost, and yet you're sitting very pretty.
What are those IRRs you're talking about?
So it depends. I mean, typically, if you look at a ground-up development project, equity return ought to be on an unlevered basis, 20% plus in our book. If it's value adds, obviously it's mid-teens. So that will be kind of, we don't do much stabilized. We think it's too boring. We leave that to the pension funds to take care of.
What are you getting in private credit?
Yeah, so on the private debt side of things, I mean, you can get close to value add returns, which is not bad. Because don't forget, you've got typically minimum 30% equity ahead of you, so they'll take the first haircut in case there's something. Now, I think that is okay for now. It will change because we are starting to see a little bit of pivoting within the debt market. The banks are starting to come back to life again to a degree. So I think, and also as interest rates come down, it will get a little bit more pressure. But in the short term, medium term, I think you'll still do quite well with private debt to an extent. But the outlook is probably with the arrow pointing down. Therefore, I think in a year's time, if I get the same question, that allocation will probably shrink and go more into the equity side and lead more into real estate, full stop. That's us.
All right, Lane, I think you can take an hour and talk about anything. How do you, I guess, fixed income? That we want to.
Yeah, my name is Lynn Wall. I work for State Street as one of the GSIP US financial institutions. I work in their investment portfolio, primarily in public debt. So I follow, especially my team, focus on global interest rate and government debt as allocation. What I want to concur is I don't find fixed income, at least the developed market fixed income at the current stage with the massive rally is attractive. I do feel we've been in this juncture several times over the last couple of years, during SVB failing, during late last year, market just rising very much one way, 10 cuts are going to come consecutively. Which is what's happening right now. You've got fixed income market, US Treasury in particular, pricing close to 10 cuts consecutively back down to just below 3%, whereas equity valuations, quite hefty. So, one of the markets strong somehow. And I feel that it is, I've been a raised fixed income investor all my life, and traditionally they're always more pessimistic than the equity investors. So that's a permanent trend. So, but I do feel there's a lot of priced into the market in terms of interest. It has to be a very deep kind of hard landing to justify the current. Back to allocation, I do feel, not just now going forward, but even over the last 5 years, you see, with the COVID, a lot of disruptions, especially in public debt market, there has been so much played by the central banks, the QEs of the last 10 years. The macro hedge funds has been out of favor for a long, long time until recently, last few years. So what it signifies is the, we're no longer in a data passive fund, like strategy, you just get on long anywhere. I think it is coming into a market. You see a lot more divergence among central banks, among economies. We've seen between Canada, Australia, Canada very divergent from the US over the last, couple of years and going forward. And Europe is having a different trajectory, let's say, from, the emerging market in China. So I think we're in an era that we should, value active management, looking for values across different rather than getting on, one way data trade. So that probably, apply for regional. So we've been looking at, divergence between Australia and Canada. Usually in government market, you have very low, high correlation. What we have seen is much higher divergence. Those spreads could move 120 basis point. That's just unheard of when all interest rates are close to zero. So there's plenty of opportunity there that we can. And then from asset class, not long ago we had, U.S. mortgages are significantly cheaper than corporate credit, and then that has also corrected more recently. So in a recession, especially the IG credit is extremely tight. If there is any slowdown, let alone recession, they're extremely vulnerable. Whereas mortgage, for example, is guaranteed by the U.S. government, and then it was very wide last year because the banks stepped back after SVB. So eventually, when valuation is attractive, the investor do come back. So I found this very interesting.
Let's talk about that. That's a really interesting, because you manage a book differently than they did, right? Is your book, how big is the
We have about close to 100 billion, but mostly mortgages and the U.S. government, and global government bonds like Europeans, UK government bonds, and U.S. treasuries.
I haven't talked about duration, because when we talk about mezz-like returns or equity-like, what's that, 5 year? But are you talking 5 year or 1 year, 2 year, 3 year?
Yeah, I think the opportunity is between 1 and 3 years now, because it will start to come down. The pressure is coming in.
How long do you look? Are you going out on your trades? So these like days, weeks?
You mean the timing? I mean, we're more long-term investor because we're liability matching the deposit duration of our banks. But I mean,
when that happened, did you relook at duration? Or you felt like you were already in a secure?
Yeah, we definitely use a lot of interest rate swap or other derivatives to manage our interest rate. For example, last October, was that fear of inflation running away. You got 5 year U.S. Treasury trading because 5%, and people are talking about 7-8%. Now nobody talk about that anymore. And right, massively. So there are different times when we take pretty significant duration shift, and then we do a lot of duration allocation between euro, dollars, and Canada, Australia, which is smaller market, but there's tend to be having a lot more relative value opportunities there.
And how often do you adjust your tactical asset allocation and views?
Yeah, I think that's what I'm saying, that the last 3 to 5 years, because the central bank and the economies and the inflation dynamics across regions are so different. They're probably all coming down, but I think those opportunity we have done 2 to 5 weeks trade to 3 to 6 months trade, because that opportunity, if you think of the QE era for that 10 years, it's really, you don't see that volatility at all. I think that's partly the reason there's a lot more macro hedge funds that booming up in London and everywhere in the world.
So as much as I want to hear from you, Amir, I think it's more, let's keep it with Stephen, and then you will make us feel really excited about the venture market.
So I would just say for me, I would be moving back to a traditional asset allocation strategy, the way that pension funds and the endowments used to do. I think we're moving off of zero interest rates, hopefully for good, because I think if we go back there, none of us are going to be very happy in this room. But I think you want to get back to traditional asset allocation of public equities, venture, private, and get it normalized, where I think we've gone too far in a lot of different directions. I also agree very much to think about balancing your passive exposures with active exposures in this environment. I think there are greater risks there than I think people fully appreciate. And while I said what I said about Europe just a minute ago, I do think there are really good opportunities in companies there. So I think you want to be in these regions. I think it's the weightings and how you shift around more tactically, because I think we're moving back to more normal interest rates with a very different economy. And I think you have to make some adjustments that way. But I think some of the areas that have been really hot are going to get killed in the next cycle because zero interest rates are not coming back.
So just what really hot, you're saying some of the AI, what do you say?
No, I think the one that scares me is how much money is moving to private credit right now. I just think we've done this. We're much better in the investment management business at creating products than we are delivering on them over the long term. And whenever we get this much money flowing into one area that fast, the bad things start to happen and the quality, credit quality and other things start to drop.
But the difference is the banks aren't being banks like they used to be either.
But they're starting to now be able to be banks again, I think.
What do you think?
I do think they're going to start lending a little bit more, but not the way the old thing was going.
State Street, are you gonna sort of come eat the cheese of the private credit market?
I think a lot of asset managers are bringing out new products. I'm not surprised, but I do agree. I think, that's why you find that and there's money to be made there, but I think you've got to be very careful in security selection. As to banks going back, I do feel that would be the case because the last 2-3 years, especially when interest rate high, the beta, whatever the margin from just sitting in billions of deposits, so you just money sleeping there and then make money for you. I think with the Fed stock, I don't believe they're going to cut 10 times, but even if they cut half of it, then you get that, kind of lazy money, making money for your banks is going to go away. So they have to get back into kind of traditional lending and then to get back to the normal bank.
Now for venture, by the way, I think this venture private credit, that's sort of what SVB was doing, and they got ahead of their, I always found that a little bizarre anyways. You're just backing Andreessen, not the asset. But Techstar, last year you were with Techstars, you were helping them optimize how they were looking at things.
Yeah.
How do you see the world today?
So at the moment, I'm spending a lot of time with strategy and how to have funds, PE, private credit, pro rata funds, secondary funds, all kinds of funds are using AI internally to optimize whatever they're doing, workflows. Right now I have a 38-page process for one fund, automating that. I think it's interesting because people are becoming very aware of where they're leaving money on the table, but they're also using strategies that are very different. So, from cashing out or providing credit to LPs in funds or providing the capital that's being called as a lending arm. I mean, there's a lot of these strategies popping up, maybe because of SVP. I don't know. But what I'm seeing in venture is very interesting because you're seeing a lot of this sort of roll-ups of the new venture. What you're hearing in GCC, a lot of cleanup. A lot of these companies that were purchased that need to be cleaned up, a lot of value creation. So there's a lot of value creation activity. A lot of people are trying to do that, trying to make the businesses actually function in a high cost of capital environment. This is pushing a lot of people to think differently than, the zero interest rate environment. So I'm engaged anywhere from value creation at a portfolio company level to how to look at an entire portfolio and identify exactly what are the low-hanging fruits you can hit from a Gen AI, from machine learning, from a quantitative perspective. But what I'm seeing with venture is a lot of venture got cleaned out. A lot of people got cold. A lot of people have either moved on or moved into other industries within finance. And then funds that are doing well or that have traditionally had the right deal flow, they're doing fine. But now it's interesting. Yesterday I was at Cambridge Tech Week and I met a lot of the people in Cambridge. They have a lot of bioscience. They have no way to access the investors. They have difficulty finding the investors. And what's interesting is I'm meeting with the CEO of UKRI based on this idea that the velocity of money in the UK is not functioning as it should and how they're being zero tactical in terms of how to deploy capital. So very much like a fund, they're also looking at being tactical. Now, interestingly enough, I think UK can probably achieve that. I don't think the US can as much because it's so large and there's so many competing interests. But there's a lot of activity here, at least in the current government, to be more tactical about that deployment. And it's the same with funds. Funds are not being as free with the capital. Techstars, Antler, Startup Bootcamp, Entrepreneur First. I've worked with all of them to some capacity. I've seen what they do. I think everybody right now is deploying Gen AI, and there was this hype about data-driven VC. A lot of those people got fired, or they're no longer useful. Because basically they can do a lot of what they're doing with Gen AI, especially in marketing. So you see marketing departments grabbing that like crazy. But with funds, the funds that have good portfolios so far, and they've shown access to good deal flow, they're still getting capital. I think, Atomico just raised $1 billion in one fund and then 300, 400 million in another fund. They have really quality deal flow. They've been in some really good companies. So they're going to continue having no problem. Newer funds, small funds, they're still raising, but purely on network. So, and you're seeing this, but if you're a fund that's been, you're in fund 2, trying to raise money and you didn't do so well, and none of your AI related investments or your bioscience investments or any of them have any traction, it's very difficult to have a conversation with your LPs. This is what I've seen.
What's changed for you for the time horizon when you think about going into venture now versus previously? Does anything change in your time horizon liquidity?
So I think it's very interesting because I just helped the startup get a deal with Novonesis, and they're massive. And this is a startup that's many years old, has no revenues. They have great technology, but they are not, in my view, the kind of startup people are looking for in this hype cycle that is sort of finishing. I think with the roll-up strategy that you're seeing, a lot of people acquiring separate companies and putting them together and starting a new VC targeted company, it's very much a PE strategy, right? It's 2 to 3 years. Hopefully something comes of it. If I don't see something quick, that was a bad idea. Then you have bioscience. The horizons are still long. You still need lots of investment. You need people to commit to it. You need multiple rounds of support. Commentary on UK, horrible for follow-on money, like a horrible market. And they're suffering in that.
But who is good at that in Europe? Anybody?
US funds have increasingly set up offices here to do bioscience-focused investment. OpenAI has a specific team they set up here to target bioscience. All the pharma, all this is huge. There's a guy I know that I'm working with that's setting up an 800 million.
He's going to leave and head headquarters back to the US?
Everybody sets up US headquarters at some stage. And now it's no longer let's go to Europe.
Again, what's Europe left with?
With Novonesis.
Okay, they got the pharma. Michelle made that case. But it's tough.
I think it's interesting. I know someone right now who's raising a fund to use sports as a platform. And they just closed this record-winning Arsenal deal. It was like $35 million per player. And they're going to use retail and various avenues that they're going to buy up as a platform on the IP. So there's a lot of IP in Europe that is undervalued. And if you set up the right platforms, you can monetize that. And I think it's interesting to see football growing in Europe, in the US, while in Europe it's been around and you have these players and these fans that this is untapped IP. So there is this sort of cultural IP that's still there. But in terms of manufacturing, the car industry, I don't know. I think BYD and the Chinese manufacturers are doing so well. The technology is so impressive. I don't know what the European companies are going to do. In terms of technology and scientific research, you see it. It's exactly what was said earlier. Cambridge, Oxford, UCL, Imperial. They phenomenal output. A lot of those people were European though, and after Brexit, they lost a lot of scientists. Then they raised the minimum income necessary to get a visa. So a lot of these people can't bring their partners. So it's a very interesting scenario where most of the staff is European. You get very few Americans in European universities, but like a lot of Europeans in US universities. So I think there's a lot of IP that can be exploited, and Europeans are generally terrible at the commercialization.
We have someone from home and
Yes.
So
Okay. But
prior market scientist.
she said.
But are you in the US? Are you in the
Once a scientist, always a scientist.
With the UK.
Are you at the university?
No, I'm not.
Okay, so I'm okay.
Well, I don't disagree. There's been a fragmentation in the market post-Brexit, and I have seen a huge shift, especially from a large cap perspective. What's been interesting is the shift of the evergreen funds within the large caps. So GSK actually decided to exit about 4 or 5 years ago. They had a company, venture capital arm called SR1, and so that spun out and it's private, but it was always an evergreen idea that even if they lost money, it didn't care, it was part of the mothership. But Sanofi is actually pushing off their venture capital arm, Sanofi Ventures, and they've actually funded it even further. So the large caps are certainly looking for that IP kind of value accretion, and they're definitely looking to Cambridge and Oxford to do that. I certainly agree with your comment in that in the UK, there's the infrastructure around bioscience to, I guess, incubate those ideas to then have the right infrastructure to understand where that value creation could be. So if it's IP, if it's the actual asset, it depends if you're traditional pharma, health tech, med tech, or device, etc. But I think there's more of a push for large cap getting involved where the funds are there. It's just a matter of then how do you, because large caps want to share the risk, right? So they're going to go out to a handful of VC or PEs to share that. So how is that partnership playing out is kind of the
Anyone else? Comments on geography or assets before we split up? Yeah. Please.
So my name is Anne Berger. I'm the CEO of a medical research charity in the UK. And we're quite unusual because we're a private foundation. We have our own money to do what we want in the areas that we want. And we only fund and invest. So we've got about 350 scientists that we're supporting. Initially, we did say a big drop off the Europeans coming to the UK, but actually they're coming back. And now that we're seeing our postdocs and our principal investigators across the country advertising roles, they are getting very strong applications. So the science is moving very quickly, and we're seeing quite a lot of money coming back in, and it's exciting times. So I can tell you from the coal face at the earliest stage, earlier than you might want to be investing in, there's some really exciting stuff going on. And I think the organisations we're talking about here are UCL, Cambridge, Oxford, Edinburgh, Manchester, some very, very exciting stuff, particularly in big data. And we have one unique aspect in the UK, which is very impactful, which is bringing money back in, which is the data on patients and the NHS. And we can now start recruiting. There's a big move here to recruit 5 million people into clinical trials. And we're one of the few countries in Europe that has that enriched data we can go mining. So ultimately, we're going to be quite interesting to big pharma, particularly for new drug discovery. So just a slightly different perspective.
Well, okay, we'll have a health tech. We're going to have a health tech breakout later. You guys can all get together. I want to keep this going on time. Any last comments? I mean, there was. I'm going to mispronounce it. Where James was from, where you brought the device forward. What's the city? Cheltenham. Yes, I didn't hear that. There's another epicenter of innovation, right? Let's do this. Let's thank our panelists. Put on the slide where the breakouts will be. This is the messy but magical part of 361 first. 360 is about roundtables. It's the sort of foundation of who we are. The one firm was Arthur Anderson. The global collaborative culture going by Bardos. What we're asking you to do is, if you are interested in, you go to that slide. You might have to refresh it. If you're interested in anything regionally, the regional breakouts are going to be at room 7. So you'll meet Roberta, who's together with, we're putting on this amazing conference in Riyadh, which we talked about earlier today. So I'd expect whoever Meredith is, you'll be in the GCC breakout. We can continue this discussion of the UK, Europe, then we had India, Asia. So those discussions will happen in that room. And if you're interested in DCPE, soon the numbers will pop up, or public markets, or private credit that Pura mentioned. I should put it with real estate. Then they'll have a number. So what we ask you to do, we'll put this up in a second, but flip now just to how we do breakouts. It's another slide down or so. 1 moment. So, and this comes from doing alumni networking. This was my passion project. I should tell you how 361 came about, but we'll do that later. But while that's true, I want to go to the principles of how we do breakouts. There's a slide on. Keep going. Almost there. There it is. Back up. There it is. So the key is for everybody in the breakout to introduce themselves. That's the 360. So you know who's in this breakout. So I know that you're almost forming your own digital assets breakout. I saw, which will happen later. But if there was a speaker, and I don't think we really designated speakers, but if one of the panelists, you want to ask the panelists this wax, like, why do you think Riyadh, like, what was that like? You told, which ministry did you like? Which, I mean, I'm very curious. Like you said, you must let them drink. That's one of my takeaways today. The McKinsey proposal to the Saudis, how you're gonna, and you missed that. Sorry, earlier today. So,
I'm quiet.
10 years ago, telling them that, McKinsey telling them that you have to, let them drink to grow and bring the best talent. And they were the only ones who apparently did that. In any event, you can go join that breakout, but it's a more of a discussion of that, how you see the region. But secondly, it's this, what do we want to do as a group, future events? Now flip back up to our, right, not there. No, the events page.